Tamikaze here with a video on fundamentals. This is episode 2, the price to earnings ratio, or the PE ratio. So what is a PE ratio? This stands for price to earnings. This is calculated by dividing the market value per share by the company's earnings per share, aka their EPS, which is just a way of saying it's the company's net income per share. So both of these are core fundamentals and need to be paid attention to when evaluating fundamentals in a company. So now that you know what the PE ratio is, how does it help you analyze a company? So it should be noted that PE ratios need to be compared to other companies within that same industry. So like comparing Apple to Microsoft, for instance, is fine, but comparing Apple to the Bank of America, you're going to get widely different PE ratios, and it's not going to be the same thing. So PE ratios can be used to determine whether a company is overvalued or undervalued based on how close it is to the average for that industry and the overall market. So if you see a stock with a high PE ratio compared, so like Apple with like a PE ratio of 30 and the tech industry ratio of 40, might be considered as undervalued. But if the tech PE ratio industry is 25 and Apple's is 30, it could be considered overvalued. But it's just one way of looking at it, and we'll talk about how you can combine this with other fundamentals to get an overall view. So if you see a company with a high PE ratio, you need to look into a couple more factors. So if they have large net income and the revenue keeps increasing, this can be considered bullish as a company. Investors may be seeing this as a rise in income and revenue, so they're willing to pay a higher PE ratio because they see the stock continuing to go up. So we also need to combine this with forward PE, which we'll talk about in a second. Inversely, if you see a low PE ratio, you need to look for a bunch of different things. There could be earnings growth slowing. There could be some sort of government regulations that are holding it back. Could be international politics. Maybe they do business overseas and are affected by international regulations as well. A lot of times when you have low PE ratios, but you have good fundamentals, you need to look in what is called FUD, fear, uncertainty, and doubt type of aspects. And those can be any of the ones I just said, or they could be like the war with Russia. That could be another thing that's considered FUD that is holding the stock down. Investors don't feel comfortable putting money into that. Doesn't mean that you shouldn't. A lot of times you want to buy into fear because if the underlying assets and uh, valuations of the company are doing well, buying on fear could be a way to get undervalued stocks. So let's talk about the forward PE ratio. This can be combined with the normal PE ratio to help us determine whether a stock is overvalued or undervalued. So while the current PE ratio is calculated off of actual earnings that are reported, forward PE ratios are based on projections or guidance. So when a company offers guidance, this can be used to determine the forward PE ratio. And I like using the combination of the two because if you keep seeing the forward PE ratio higher than the normal PE ratio, this is a very bullish sign and can show a real change in growth, and that's how I like to buy off of the PE versus forward PE. But inversely, if the forward PE ratio is lower, this can be shown as contraction in earnings and can be a bearish sign. So when you combine the two, signs to buy would be the forward PE is lower than the current PE and the PE ratio is lower than the industry. This can be a very good sign. And if you have earnings growth and revenue growth, you're really going to want to look into that. And another thing we'll cover in another video is you want to look at their balance sheet. So we'll make a video on the balance sheet probably as the next episode. And this could be determined, what is their debt to equity? Do they have good cash flow? Do they have good cash on hand? Can they cover all their debt? So if they can't do that, that can be a sign to sell the stock or short it. So if the forward PE ratio is higher, This can be seen as earnings slowing down and growth slowing down, or there could be a whole bunch of reasons for it, increase in expenses, things like that. So you also want to see if the PE ratio is higher than the industry, and you want to look at the like I said, earnings decline, negative earnings, revenue decline. So if a company is burning cash and they're not profitable, depending on what their war chest looks like in cash, it's possible they'll need to do a share offering, which will dilute the stock. So if they do a 10% share offering, that could push the stock price down 10%, and that could be a bad sign. So these are just some ways that I use the PE ratio. I find it as one of the core fundamentals I look at. It's usually the first thing I look at, and then I dive into the spider web of fundamentals after that. So hopefully this helped you. If you like the video and you don't want to kill a unicorn, like and subscribe, and we'll see you in the next episode.